In the United States, the longest government shutdown in the country's history has officially ended after lasting more than 40 days and paralyzing a vast segment of the American economy. This was not just a technical pause of federal institutions. Analysts describe it as the most dangerous political and economic freeze of recent decades. And the issue is not merely that hundreds of thousands of federal workers went without pay, or that hundreds of programs, from statistical publications to financial market oversight, came to a halt. The main problem, according to independent experts, is that the shutdown became a kind of curtain behind which, insiders claim, far more serious structural defects of the American economy may have been concealed. Now that the government has reopened and regular data releases are expected to resume next week, the attention of the global financial community is fixed on the United States with unprecedented anxiety. According to specialists from the Peterson Institute, the data that were frozen during the shutdown may reveal the real state of the American economy, and it may turn out to be far worse than markets assumed. Economists from Gallup Research report that internal indicators of demand and consumer behavior collected before the suspension of official statistics were already showing worrying distortions: a decline in consumer confidence, a drop in retail transaction volumes, a slowdown in online demand, and a sharp reduction in purchases of durable goods. These data were never released. They were blocked as unpublished during the shutdown. Now, as the flow of statistics is about to resume, many experts believe that we stand on the threshold of one of the most painful moments for global markets in the past 20 years. Anxiety is increasing against the backdrop of Donald Trump's tariff policy, which publications from Bloomberg to The Economist describe as the most radical trade experiment in modern America. The new tariffs, according to senior officials, are supposed to protect American jobs. However, independent think tanks, including the Rand Corporation and the Brookings Institution, warn that tariffs will inevitably hit domestic prices, triggering a new wave of inflation that could become even more aggressive than the inflationary crisis of the years 2021 to 2022. Closed reports from major banks already point to a sharp increase in the cost of key electronic components, construction materials, and household appliances. Insiders from the largest distribution networks in the United States claim that companies are preparing for a wave of price hikes in January, when the new tariffs on Chinese imports take effect. Some retail representatives openly tell journalists on condition of anonymity that if Trump continues to apply pressure in the same way, America will face systemic price growth at a level not seen in a decade. This, they say, could break the consumer market. A collapse in consumer demand is now the primary risk discussed in the largest investment houses. Another threat is emerging against this backdrop: a giant bubble in the artificial intelligence market. According to analysts from Goldman Sachs and Morgan Stanley, the current capitalization of American AI companies has risen to levels that are not explained by real cash flows. In other words, the market may be inflated by speculation. Some experts compare today's frenzy around AI technologies with the dot-com bubble of the late 1990s. Explosive growth, belief in endless expansion, expectations of billion-dollar profits sometime in the future. Market participants continue buying shares of tech giants and semi-private AI startups despite the lack of confirmed profitability. Inside Wall Street, a joke is already circulating that AI is the new oil, but it is increasingly told with unease. The team of analysts from the Center for Financial Stability in New York states directly, if the Federal Reserve System tightens monetary policy against the backdrop of rising inflation, and if the publication of statistics after the shutdown shows a sharp slowdown of the economy, the bubble of artificial intelligence may collapse within several weeks. And the consequences will be catastrophic, because today, the sector of artificial intelligence is pulling along the entire market, from high-technology companies to infrastructure suppliers, logistics, and industrial production. Any correction may trigger a chain reaction. In parallel, demand for gold is growing, and the pace of purchases has already exceeded the levels observed before the crisis of 2008. According to the International Monetary Fund, the central banks of developing countries, including China, India, Turkey, and Saudi Arabia, are actively increasing gold reserves. Experts from the Financial Times note that such a surge is rarely accidental. Large states increase their gold stocks when they are preparing for risks of banking crises, geopolitical shocks, or financial turbulence. American private investors are doing the same. Data from the largest brokers of the United States show record volumes of gold and silver purchases by retail clients. This, as analysts from the Bank of America emphasize, is a reliable indicator of fear of economic uncertainty. The growth of demand is occurring exactly at the moment when data on the state of the economy of the United States were hidden by the shutdown. And this is a worrying signal. Economists suggest that major market participants expect unpleasant surprises in the statistics that will be published in the coming weeks. An additional layer of uncertainty is added by mass layoffs, which have continued for the second consecutive month. The information portal Business Insider writes about large-scale reductions in technological, transport, logistics, media, financial, and industrial companies. Layoffs are recorded both in giants, from banks to aerospace corporations, and in medium-sized businesses. Experts are particularly alarmed by the fact that many layoffs are occurring in the retail sector, precisely where Americans traditionally spend the main part of their income. If consumption falls, the economy loses speed, and if unemployment rises at the same time, this is a direct path to recession. Insiders in several large retail corporations claim that their companies are recording an illogical decline in sales in recent weeks, a decline that cannot be explained only by seasonality or weather. The first to begin to feel the hit is the Walmart chain, the #1 indicator of American consumption. Reporters from the Wall Street Journal, citing their own sources inside the company, report sales in some categories of goods have fallen so sharply that the headquarters is discussing a revision of the annual forecast. Declines in demand for clothing, electronics, household goods, and automobiles are already being recorded, but the most alarming is the decline in food sales at the regional level. If Walmart sells less food, it means Americans are truly economizing on basic needs. This is always a signal of deep problems. An internal report that fell into the hands of Reuters journalists states directly, the decline in consumption is systemic and may be a sign of an unfolding economic shock. If the situation does not improve within the next 2 months, Walmart may, for the first time in a decade, announce a reduction of its revenue growth forecast for the next year. This will be a blow to the markets, which considered Walmart one of the last bastions of stability amid the shutdown. In parallel, concerns about the debts of the banking sector are growing. According to the American Independent Association of Banking Supervision, the level of overdue loans in regional banks has reached marks that were last observed in 2007, 1 year before the global financial crisis. Whether Trump's policy will become the very trigger that sends the American economy into a new historical crisis is a question for which there is no answer today. But one thing is obvious: the world is preparing. Major investors are watching. Governments are strengthening reserves. Central banks are buying gold. Corporations are tightening expenses, and financial analysts are publishing increasingly alarming forecasts. The publication of the first official data after the shutdown will become a moment of truth, and if the fears are confirmed, the market may face the largest collapse since the global crisis of 2008.